interest rate or APR. Which should you focus on when getting a mortgage? Hey there, future homeowners. Welcome back to our channel. Today, we're diving into an essential topic that can impact your mortgage decision-making process. Mortgage APR versus interest rates. As a mortgage loan officer, I understand the confusion that arises when comparing these two terms. As a senior mortgage loan officer for over 17 years, and I got this question all the time. Why are there two rates on my application package? What's the one I got and why are there two rates? What does APR mean? In this video, we'll answer the questions you have and explain differences between APR and interest rates, and what you need to be aware of. So, let's get started. Before we get into the details of APR, let's first understand mortgage interest rates. When you take out a mortgage, the interest rate is the percentage charged by the lender for borrowing the funds. For example, let's say you're considering a $200,000 mortgage with an interest rate of 6%. That means, you'll pay 6% interest on the outstanding balance each year. A lower interest rate can result in lower monthly payments and save you thousands of dollars over the life of the loan. Definitely the lower rate, the better, and also means you are paying lower interest cost overall in the life of the loan. Now, let's move on to Mortgage APR. APR stands for annual percentage rate. Unlike interest rates, which only reflect on the monthly mortgage payment, APR encompasses both the interest rate and additional costs associated with the loan, including origination fees, closing costs, and discount points. To illustrate, let's consider the same $200,000 mortgage with a 6% interest rate. However, if the APR is 6.85%, it indicates that there are additional costs involved, such as fees or points, which also increase the overall cost of the loan. The APR is designed for helping borrowers to understand when borrowers see a lower rate that the loan officers offer, and if there is any hidden high closing costs that your loan officer didn't reveal to you. They might show you the rate of 6%, which is lower than the other loan officer's 6.25%, but what you are not aware of is that they probably charge you 1 point of origination fee to get to the lower rate. 1 point based on the loan amount is $300,000, and it's around $3,000 cost of the fees. They put in the $3,000 closing cost into the rate, and using the formula and came out with an APR rate. So, how do APR and interest rates differ? Well, while interest rates directly affect your monthly payment, APR incorporates both the interest rate and other costs associated with the loan. For example, if you're comparing two mortgage offers with the same interest rate, but one has a higher APR due to additional fees, you should compare and look closely at the itemized closing cost, and find out if there are any excessive lender fees that you are not aware of. So even if the rate is the same, it doesn't mean you get the same deals. That's very important tips when shopping for the mortgage. Now, let's talk about whether you should get a higher rate with lower closing cost, or vice versa. If you're primarily concerned with your monthly payment, and want to keep the monthly payment or DTI low, and you probably need to get lower interest rates, even you have to pay upfront points. When it's a buyer's market, you probably can check on seller's assistance to see if they can help cover the points you pay, and the closing costs, so you can lower your monthly payment without burdening too much with the fees. Overall, paying attention to APR and the interest rate you got is always good when you're comparing and shopping for your mortgage. If these two rates are not too far apart, and that means your closing cost is lower, but if APR is a lot higher, then you probably want to check if that's because of some additional cost that you are not aware of. Simple tip for you: if you're considering two mortgages with the same interest rates but different APRs, the one with the lower APR may have lower closing costs, making it a better option for you and easy to compare. In conclusion, always check a breakdown of the closing cost. Some are just estimates, and some are real cost, and some are third-party fees, nothing to do with the lender. You need to find out if lenders charge very high points or lenders' fees on their end, since these are real costs to you. As a senior mortgage loan officer for over 17 years, I know how important it is to understand these concepts to make informed decisions. Remember, interest rates impact your monthly payment, while APR provides a better way to understand the overall cost, and the cost you are not aware of. By having this knowledge, I hope you are not as confused as before, and have a better idea of what you should compare when shopping for a mortgage. If you found this video helpful, don't forget to give it a thumbs up and subscribe to our channel for more valuable insights on the world of mortgages. Thanks for watching, and I'll catch you in the next video. Ready to navigate the world of mortgages with confidence? Subscribe to our channel for more tips and guidance tailored to your needs. Hit the notification bell to stay updated with our latest videos. Thanks for watching. We will see you soon in the next video. Claire Lynn, Senior Mortgage Professional, NMLS ID number 299,165. Your Best Home Rate LLC. We care about you and your loan.